the track record is encompassing of Fund 1 and Fund 2. Across those two funds, we've acquired 28 deals. 96% of our investments have outperformed our initial projections on both an IRR and a multiple basis. We tend to be conservative, as some might say. I like to say that we're realistic about the world, and we adhere to institutional underwriting standards, and that has benefited our Fund 1, our Fund 2 investors quite a bit, and us as well. And institutional underwriting standards are simply, for those things that we don't know, we assume worst case. We don't know where interest rates are going in the next 2 or 3 years, so we underwrite higher interest rates in the future, and that's very easy to do because there's something called the LIBOR curve out there that we write into every deal. We don't know where cap rates are going to be in 3 or 4 years, so we underwrite higher cap rates on an exit price than where they are today. So as we look at the world and where the risk is, we want to make sure that we're covered, so if things start to move against us, that we're still going to be able to meet our projections. And certainly those underwriting standards have benefited Fund 1 and Fund 2 investors quite a bit, because as we were underwriting assets in 2011, 12, and 13, and assuming higher cap rates in 2016, that certainly didn't come to fruition. So we were able to generate much higher returns than what we initially projected. Fund 1 is on track to achieve north of a 25% net IRR and a 2.2 multiple to our investors, and that's a net multiple. That's after all fees are considered. And Fund 2 is on track to achieve north of a 20% net IRR and a 2.1 multiple on equity. That performance in those funds places us in the top 10% of fund managers, and that's according to an independent database called Preqin that we subscribe to and submit all our data to. So let me move to the next slide, and this is really what we're trying to do for us and our investors, and we're trying to build wealth. And building wealth comes through the compounding effect of being in funds and deals that multiply your equity. So not necessarily IRR driven where we're in deals for 6 months or 8 months, but we want to double our capital over the hold period. And I think the one thing that we've done very, very well is doing it in a short time. So Fund 1, from beginning to end, the first capital call to when we will be out of all of our deals will be about 6 years. And in private equity, that's very, very rare. Most private equity companies, there's a very much an inherent conflict of interest that they want to build equity under management. And the way you keep equity under management is by holding deals for 6, 8, 10 years. We have smaller funds, we turn them quicker, and the impact of that is that for our Fund 1 investors who invested in Fund 2, or I'm sorry, invested in Fund 1, and then rolled those proceeds into Fund 2, so if they invested $250,000, that would have yielded about $550,000 in proceeds. Rolling that into Fund 2, and we have some of this is projected, still hasn't been realized yet through 2018, but over that 7 to 8 year period will result in about a 5.2 multiple on equity. That's what we're trying to do with our money, and that's what we're trying to do with our partners' money as well, is really create a multiplier effect, and that's how you grow and protect wealth. And we've done it with little to no losses and by protecting investors at every stage using responsible leverage throughout.